European car manufacturers are panicking right now. Chinese competitors are flooding the market, prices are collapsing, and some of the biggest legacy auto stocks are down more than 50% over the last 5 years. But here's the twist. While everyone is focused on the car makers, one lesser known company in the same industry has quietly gone the other way, up more than 40%. So if you are thinking about investing in the auto sector, you might be looking at the wrong place, because the real opportunity might not be the manufacturers at all. I'm Daniel, a former London stockbroker and worked in finance for 10 plus years. And if you want to see more videos like this, hit that subscribe button. Now, let's crack on. The company is AutoWallis. But this is not just a simple car company. It is building a Central and Eastern European automotive platform that combines car distribution, dealerships, servicing, rentals, fleet services, and car sharing under one umbrella. That matters because a business that touches several parts of the car value chain is very different from a simple local dealership or a traditional car manufacturer. AutoWallis operates in 17 countries across Central and Eastern Europe and selling more than 50,000 cars per year, which is almost equal to the total new car sales of some countries. For example, in Bulgaria, 49,000 cars were sold in 2025, in Slovenia, roughly similar, and in Croatia, roughly 70,000. But the beauty is that the company does not only sell cars, but does repair services, offer car rental services, and distributes spare parts as well. So if you've bought or serviced one of these brands in the last years, it's very likely that you've interacted with AutoWallis without your knowledge. And now they are increasing their market share thanks to the new Chinese car brands such as XPeng, NIO, and BYD. In addition, if you rented a car in an airport from Sixt, that also belongs to AutoWallis. Now, it's great to analyze a stock from the outside, but I think it's much better if the CEO of the whole company talks about the future vision of the company, how the new Chinese brands can affect European markets, and how the legacy car manufacturers gonna deal with this whole situation, and many more. I had the privilege to make an interview with the CEO of AutoWallis, and that's what comes next. And now we are here with Gabor. He's the CEO of AutoWallis. So thank you very much for taking the time. Obviously, I should say that we are in your office, so I should say thank you for my time, basically. So
thank you for coming.
So first of all, I wanted to touch base on, because now we all know what AutoWallis does as a day-to-day business. So I wanted to touch base on what you see in terms of the trends in the car industry, because obviously after COVID it was quite hectic. There were times when people had to wait literally 10, not even 10, 50 to 100 weeks to get a new car. But now we already switched back to sort of normality, or we can call it normal. So I wanted to be talking a little bit about what you see, what happened since COVID, what happened since 2020 during the last, let's say, 8 to 6 years. And also we'll be talking about at the end of the video and the interview what happened, what is going to happen in the next, let's say, 3 to 5 years.
Yeah, I hope you can tell us what will happen in the next 5 years.
I mean, that's why I'm here, so you have to tell me, come on.
All right, I have my view. Sure. COVID was obviously a very disruptive period, and it definitely had a great negative effect on the supply chain, and that caused the waiting lines. And that was a period when, and in the previous years as well, when there was no cost of stocks. So while supply in those years were very scarce and very long waiting, the demand side was very strong because people couldn't travel, so they had money to spend, and they also had the subsidies from different government sources. So it was a completely imbalanced demand-supply situation. Now that has changed, obviously, in the last 3 to 4 years, which first of all saw a supply readjustment, so to say. So some of the production facilities adjusted by cutting production but also issuing new models, bringing back production from different other continents in response to COVID learnings, but also in response to the newly introduced global, how to say it, trade war elements. So there is an inshoring which changed the supply part of the equation. But on the other hand, another consequence of this reshuffling of global economy was the interest rates. So now we again face long-term and short-term raise of interest rates in the economy. And so as stocks came back on the market, in every automotive market, the cost of it hit pretty badly after the golden years of no interest and then no supply when scarcity solved everything. So now we are in a normal supply chain situation. The demand is now the big question, because people's savings and money are running out. Economies are responding, hopefully with a soft landing, to all these global changes in the competitive situation. But definitely there is in our region, there are some macroeconomic issues that needs to be looked upon very cautiously. First Hungary, then Romania, and other countries are under pressure regarding their budget situation, which will somehow affect the demand not only of the public but also the corporate sector. So we need to be cautious. However, all in all, to answer your question, I see a normalization of the supply-demand equation. So now we are in a new equilibrium, so to say, which also resulted in a decrease of the general margin levels after the golden years of COVID, so to say. So now we are back on normal, and at the end of the discussion we will see where we are heading to from here.
Just one quick question. You mentioned that the profit margins are squeezing a little bit, obviously based on COVID levels. What is do you know an average number that as an auto sales, or there's no average number because it's with different brands, there's literally different parts of
I mean, I have to be honest, automotive industry, as we all know, is cyclical. So there are years when there is higher margins to be kept in the sales channel. There are years when the clients have all the advantages and all the margin, and sometimes the production, the factories have to rebound as well, so they keep as much as they can. So there is a continuous adjustment, so to say. On average, it's very difficult to say, and it has differences in our region, even in countries, but definitely has a greater differences on the global scale. South America is very high on average and longer term history, whereas Europe, where the competition is the fiercest, and the US obviously, they tend to have lower margin levels on the long run. So
to speak, so nowadays, which part has more advantageous positions? The consumers, the customers, or the auto brands, the car makers, the manufacturers?
In Europe, I can definitely say that these are the years of the client.
Okay, so it's great to buy a car. That's what
I wanted to promote. Exactly.
A little bit marketing, of course.
Although I understand that there is a trend in the clients to postpone decisions, because they cannot predict the economic situation in their own activities or their financials at home. But yes, on the car market in these all Europe, the competition has been growing in the last 2 years, especially because of the Chinese import aggressive introduction, and also because of the response from the incumbent European producers. So now we can see very nice new models on very good prices from Chinese brands. It's worthwhile for exploring, but also there are new and new models coming from Opel, from Renault, Dacia, with very new value proposals, with very new technology, softwares, in response to the Chinese competition.
Now that you tweak the conversation towards China, obviously we wanted to talk about China because that is the...
Everybody.
Yeah, everyone wants to talk about China in the last, how many years?
Well, now we are talking about Chinese for 12 years, well, okay, maybe 13 now. But yeah, it's definitely a media fever about it in the last 3 years.
And you also mentioned before we actually started the interview that the Beijing Auto Show, is it called Auto Show?
Yeah.
Or car show, whatever. This is the biggest one now.
It became the global big one. So from Frankfurt, from Detroit, now we are in Beijing. So it became the largest. We had our team there for almost 2 weeks in different batches, but everybody is there. So this is really the largest. All the incumbent old brands from all over the world, and obviously the Chinese are very much present, introducing their new models, their new strategies, their new concepts even. And so there are many new negotiations from our side as well, with already existing brands in the market or newcomers that will enter.
How many Chinese brands do you have in the European market at the moment?
In the European market?
Yeah.
Well, I would say 15. But
15
I'm not
Chinese
sure.
ones.
You know, maybe it was
maybe
in the morning.
16, maybe
now
16,
it's not.
Okay, but the major ones are BYD, XPeng.
BYD, MG, now XPeng, NIO with the Firefly brand, also Geely entering very aggressively recently, and some others that are in different phases.
Yeah. Plus the new ones, which we obviously cannot talk about just yet.
Sorry.
Who knows, maybe the next video will be about those brands. And I also wanted to touch base on the Chinese aggression in terms of, not that they are aggressive, that how they market and do it really aggressively compared to the legacy brands. Let's call them legacy brands. Because a couple of days ago, before we record this interview, BYD came out with their quarterly earnings and their net profit went down by 55%, which is mental. That is like absolutely crazy, which means that if we take out the Chinese market, they would be profitable, but if we leave the Chinese market and leave out the European markets and other markets all around the world, they would go bankrupt like in 2 days because they are so heavily affected by the exports of to the European continent and to all over the world. So what you see in these situations, what is your takeaway as obviously one of the largest companies CEO in terms of the auto sector?
Thank you. Well, I mean, obviously the Chinese market is crazy. It is crazy. There was a artificial push to build up this automotive sector in China, the production. It is focusing still on electric vehicles. So there are some bold decisions made 5 years ago, and the result is now here. I don't know. I think they had 168 production facilities in China in the last year, and there must be a consolidation. And now we see, by the way, on the demand side as well, that China is not growing as fast as it wanted. So there is a very big disequilibrium in China between supply and demand. Supply has grown really exponentially, and demand is now under pressure. So what can they do? They will consolidate. So there will be winners and losers. Some bankrupt automakers, some will be bought up by others. So there will be consolidation because of the Chinese local market. But one of the obvious answers is to export them. If you have ample production and don't have demand at home. So one reaction from and BYD is definitely one of the more aggressive players and the biggest on their market, was to decrease prices domestically. The other is to export cars and be competitive. And Europe is one of the, or I can say, I'm pretty sure that it is the export
top
the
market
first,
that they...
the number one choice for exporting because of the.
Obviously, consumers can afford to buy.
We are still the best customers on this earth. So, yes, there is competition, and so what I can say to our viewers are that the client is now king. There is definitely a fierce competition on the European market because of this situation, and we have to be careful that there will be a consolidation. So we need to pick and support those producers, OEMs that will survive. Now, what we do is first we try to be selective and really put our bets on those that we believe can survive. And also, second, we are building a portfolio that is in itself helps us to solve this equation with the.
You got 30 each brands, right? So around
30 brands now with the incumbents and with the new Chinese, and there will be a consolidation in the European market by the incumbents as well and by the Chinese as well. So we will adjust continuously. That's what I wanted to say. That.
Okay.
Yeah.
So if I get it correctly, it doesn't really matter for AutoWallis, like what are those brands that you sell. The main part is that you have enough space on the market and you have enough brands that even if people say, do you know what, I don't want to buy a Land Rover, I want to buy BYD now, it's still the same company at the end.
We want to serve our customers the best, and we will try to serve them with all those brands that provide good value, long-term services, secondary market value. So we will make these selections hopefully on behalf of the clients as well. But yes, from the investor's point of view or a long-term strategic view, we will adjust as the market requires to adjust.
Great. And the last part that I wanted to continue with is obviously the future. Yeah. No one knows the future except for you. So no one knows the future. No one has the crystal ball to forecast what's going to happen next year, because obviously it's quite volatile in terms of everywhere nowadays. But we can say that you obviously have a strategy which you've kept in the last couple of years.
Yeah.
And then, so what is the strategy that you're going to continue doing forward in the next 2 to 3 years? What should investors look at if they join in for the next AutoWallis investor conference or investor call? What are the key points that they should be focusing on?
There are many changing outside factors that have a great impact on our industry. But many of those impacts are on the factories, on the production side, which we are not part. Our value chain is from the distribution, the wholesale, retail, and then services, including fleet management and other mobility services, car sharing, and so on. So in these value chain elements, it's much easier to adjust. So we build our growth strategy that was basically unchanged in the last 7 years are still valid. Some of the presumptions have weighted down or weighted up because for example, the self-driving cars were a big thing 5 years ago. Now it was very quiet in the last 3 years, and now they are coming back again because of the new technological capabilities, but still not solved on the insurance side and the viability of economically. So there are these big changes and trends, but what our strategy is really focusing on is to build a local presence in the Central and Eastern European region where we are at home. We know these countries. We are present in 17 countries, so we have the differences as well. They are very fragmented from the outside viewer. So our Western competitors are not so excited because there are very small, different language, different
minor things that
taxation.
They might not even think about, but it's really key. And
yes,
got it.
You have to be here to understand how much you don't understand. So that's who we are, and that's we are partnering with global brands to be present in here, and also build our local presence through 270 retail points. So it's not only our own retail points, but also our cooperating retailers in the whole region where we are present, and we try to be the most developed in the value chain, the most diverse in our brand portfolio, and also covering all these fragmented markets into a big potential that is competitive with the big Western markets as well.
And what would be the one or two words or sentences that you would say for an investor who's interested in the car making, car manufacturing, and in a broader sense, the sort of car industry? What is it that they should be focusing on right now? Obviously talking about European car investors.
Well,
watch the demand side, watch the supply side, watch the profit margins.
I think there is if I would make an investment decision now regarding production, I think this is the time in European production where I would invest. I think the major reshuffling of capacities, reshuffling of or redesigning of models, the major decisions where to invest, where not to invest, restructuring of the supply chain from globalization to nearshoring again. It's about to be concluded, and now the real bets can be taken, whether it's Stellantis, Renault, Dacia, or any other local players. Now it's the time to make, I think, bets.
Okay, that's brilliant. Thank you very much.
Thanks.
And thank you guys as well to watching this video. Obviously, don't forget to hit the subscribe button and also give us a thumbs up if you like the video and if you want to see more videos like this. And also, if you have any questions regarding the auto sector, the car sector, make sure that you drop them in comments. I'll make sure that I'll answer them as well. So, see you guys next time.